Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. European futures explode higher, with stocks set to open 7% up after President Trump's tariff pause turbocharges markets. The S&P 500 closes out its biggest rally since 2008. No relief, though, for China as the US president hikes tariffs to 125%, but says he can't imagine raising them again. Bloomberg understands Beijing's leaders are meeting today to discuss more stimulus measures. Plus, Goldman Sachs drops its forecast of a US recession, but Fed officials say the risk of stagflation remains. Good morning. Happy Thursday. President Trump blinks with the bond markets the catalyst. The US leader putting out a message on Truth Social just in the last few minutes saying more great days are ahead. It certainly was a day for the history books yesterday across US markets, with those gains, the biggest gains that we've seen since 2008. The Nasdaq 100 ending up more than 12%. The S&P closing higher by around 9.5%. The read across then to Asia has been pronounced. Look at the Nikkei, look at the Kospi. European futures, though, looking to gain more than 7%, close to 8% as things stand on that 90-day stay of execution from the US president on those so-called reciprocal tariffs. FTSE 100 futures here in the UK looking to add 5.5%. S&P futures, after the gains of yesterday, currently pointing down by 0.7%. Do you want to lean into this rally or take profits at this point? Nasdaq 100 futures pointing to losses of 247 points. Let's flip the board and have a look cross-asset. You had, of course, 3 days of upside in terms of the yields. Yields soaring high on the 10-year by about 34 basis points. That has now started to level out. There is a bit more stability in the US Treasury market, and we know the president was focused on the blowout in yields. He has referenced that. The US 10-year now at 4.28 with yields down 5 basis points. Euro dollar at 1.09 with further softness on the Bloomberg dollar index. The single currency is up 0.3%. Oil is under pressure again today, falling 1% at 64.79 on Brent. And gold rallying in the session, up 1.5% on the yellow metal at 3,129. Let's cross over to Asia right now, where Avril Hong is standing by for a check on the market reactions there. And again, they have been extreme. Avril.
Extreme indeed, Tom. I mean, we've seen the gauge for stocks in the region jumping by the most in 2 years. There are more superlatives. You look at the Nikkei jumping by the most since August, on the TAIEX the most on record. So it really speaks to not just the volatility, but this sigh of relief that's gone up in the region. 90 days, more room for negotiation, although you also get the sense that for many of the economies in this part of the world that still are dependent in a way on China until we see a pronounced de-escalation on tit for tat between the likes of the US and China, we are going to see it very difficult to see a sustained turnaround. Amid all this, the tit for tat measures, we're still seeing Chinese stocks fairly positive, although they have pared significantly the gains from earlier. We have it, I think, supported by the idea that stimulus is going to be stepped up from Chinese authorities to deal with these levies from the US. Sources telling Bloomberg that authorities are meeting today to speak on that very issue. Flip the board on stimulus, maybe to some, one of the tools to dealing with higher tariffs for China is the weakness in the renminbi. That being said, if you look at how the PBOC has been fixing things, yes, it's weak, but you also get the sense that any sort of weakness is going to be done in a very controlled manner. We saw the onshore renminbi earlier today hitting the lowest levels against the greenback since the year 2007. So really interesting what we're seeing in the currency space along with stocks in the region, Tom.
Yeah, indeed. Avril, thank you. With a check on the Asian markets as we continue, of course, to scrutinise moves in the Chinese currency and, of course, any details that come through as a result of the meetings taking place, we understand, in Beijing today. President Trump then announcing a 90-day pause on higher tariffs to most nations, just hours after dozens of US trading partners were hit with the steepest American levies in a century. Trump's about-face on his signature trade policy came after he faced massive pressure from business leaders and investors to reverse course.
I did a 90-day pause for the people that didn't retaliate, because I told them if you retaliate, we're going to double it. And that's what I did with China, because they did retaliate. So we'll see how it all works out. I think it's going to work out amazing. I think that our country is going to be at the end of a year or shorter, but I think we're going to have something that nobody would have dreamt possible.
OK, for more, let's bring in opening trade anchor Kriti Gupta. So Trump is for turning. Some of these tariffs remain in place, but the so-called reciprocal tariffs on many, up to 60 trading nations, on hold for 90 days. What are the details in terms of where this tariff decision lies?
It's tricky because technically this is good news for the markets, and you're seeing it absorbed that way from economist markets alike. I mean, the Goldman call really reversed in just less than 60 minutes after it was released in terms of recession odds. It's quite telling on the kind of mood and how volatile not only the markets are, but that the mood is as well. We should still keep in mind, though, that even with that 10% kind of baseline tariffs on everything, that is still significantly higher than the 2.5% that existed prior to this announcement. So, yes, there is kind of this relief rally in that we're not dealing with the massive amounts that were initially announced, to say, over a week ago. But they are still incredibly high. And it's gotten to a point now where so many corporations themselves have already made plans to pivot the minute that those came in. So you saw that in things like earnings. You saw that in things like guidance. You even saw that in things like shipments being paused globally. So there's a lot of this that's already feeding into the narrative. It's not just the bond market that has spooked Donald Trump. But as he says, there are deals that are coming from various countries. And that has actually been a tailwind for a lot of folks that do have supply chains in those countries.
Yeah, and that could be the new headline news in terms of what moves these markets. Is any deals that we see or any details around Japan, South Korea, the EU and others in that 90-day period, of course. There were some remarkable scenes as well in Washington. I mean, so much history in the making in just one day and a one-day period. US Democratic Congressman Stephen Horsford grilling the White House's top trade negotiator on the administration's trade strategy. This is in real time. Take a listen.
How many days? How many weeks?
I understand it's 90 days. I haven't spoken to the president since I've been in this
So the trade
hearing.
representative hasn't spoken to the president of the United States about a global reordering of trade.
Yes, I have. I've just been in the hearing with you, sir.
But yet he announced it on a tweet? WTF? Who's in charge?
The president of the United States is in charge.
WTF, who's in charge? I'm quoting, of course, from the congressman on the Democratic side. Kriti, extraordinary scenes.
Extraordinary scenes. The tension certainly ratcheting up there, but ultimately you heard it there from the trade representative himself. The president is in charge. And that's not necessarily news to a lot of people. We know that a lot of these decisions are happening on a whim and are happening based on minute-by-minute reaction as well. And Donald Trump was quite open as well in making that commentary, saying that the next kind of steps are really based on how different countries react or don't react. And that is something that you've seen has proven true over and over again. I think you're seeing similar messaging from the likes of Scott Bessent, for example, who's saying, well, wait a second. At what point was he in touch with the president over the markets and over the kind of panic that there is? There are reports in the last 24 hours that suggested Scott Bessent had issued warnings prior to Monday on things like Sunday night to the president that the markets were going to panic, and they did. The kind of Black Monday-esque event that did indeed happen on Monday as well. So these warnings have been issued by various members of his administration, but as you heard it there, the president is in charge. Yeah, but to your point as well, how Scott Bessent, to what extent Scott Bessent and Peter Navarro, seemingly both ends of different extremes in this debate, to what extent they have the president's ear in the 90 days ahead is going to be consequential as well, potentially. Kriti Gupta, thank you very much indeed. Opening trade anchor, of course, breaking down this U-turn from President Trump on those so-called reciprocal tariffs. Now, Bloomberg has learned that China's top leaders are poised to meet today to discuss more stimulus after President Donald Trump again ratcheted up tariffs on Beijing. China is not being spared, of course. US Commerce Secretary Howard Lutnick says the bitter trade standoff can only be resolved once Chinese President Xi Jinping agrees to talks.
I am not engaging with them. Scott has not engaged with them. And the president, he does expect to have conversations with President Xi, but that is between them. If we get a contact, we will just pass it to the president. And this is really about him. He has said publicly that maybe they don't really know the best way to go through. But the answer really is It's a phone call between the two leaders of these giant countries.
For more, let's bring in James Mager, Bloomberg senior Chinese economy and government reporter in Beijing. James, how is China then reacting and responding to 125% tariffs from this Trump administration?
They haven't responded so far. You saw yesterday they came out and responded to the previous round of retaliatory tariffs from Donald Trump. So far, we haven't seen anything more from the Ministry of Commerce or the Ministry of Finance, who would announce something new on tariffs, for example. But I think their heads must be spinning like the heads of many people are spinning, like that congressman you showed earlier. But the Chinese retaliation, I guess, to this whole chain of events, not just the thing that was announced 12 hours ago, but the tariffs that were announced in February and in March and then in April, I think they've shown that they are much more willing than they were last time to go toe-to-toe with the US. They're also much more willing to sort of seemingly target the US financial markets, with two of the announcements about Chinese retaliation coming at just before or just at the time when US stock futures start trading. So they're willing to sort of seemingly put the finger on US markets to try and indicate their displeasure. And they're also making their retaliations much broader. Controls on exports of critical minerals, investigations into US companies, entity listings and export bans for US companies. All these kinds of things are not things we saw in the first trade war in 2018, 2019, when it really was just about a tit-for-tat tariff exchange. So, based on what we've seen from the last 2 months from the Chinese government, you would expect that if they are going to act or react to this new 125% tariff that was imposed today, it's going to be on a similar sort of, maybe not a similar scale, but it's in a similar way to what they've done so far. And really, that comment from Commerce Secretary Lutnick about there's going to have to be a call between President Xi and President Trump, is really not how the Chinese have acted, or not how they act in these kind of situations before. They do not have, the first port of call is not the president. There is a long process of various meetings at lower levels in which you gradually agree what you're going to agree, and then finally you'll see a summit meeting or a call between the two leaders. But if that's what the US is hoping for, we could be waiting a long time for that phone call.
I think you underscore a really important point that may be being lost, at least amongst some in the Trump administration, is the disconnect in the approach around the mechanisms for having that meeting, as you say. James, on the economic front, what levers can China reach for? We know there's a meeting between senior leaders later today, at least that's the reporting. To what extent is the yuan the favoured pressure valve in this situation?
I mean, clearly the PBOC has been given license to devalue the currency slowly. You've seen them setting the fixing slightly lower each day, slightly higher each day, allowing the yuan to sort of gradually depreciate over time. So that is one thing that they are doing, but they obviously want to keep a handle on that. They don't want to lose control of the currency like they did previously, and they want to blow through the reserves that they have. So that is one method they have. But I was talking to one of my colleagues earlier today, and we were saying the housing market the housing bubble has collapsed. So there isn't a housing bubble or housing demand that you can re-stimulate and quickly see a boost from that. Export demand, which drove a third of growth last year, is obviously going to be weaker this year because of these tariffs on China. So the government, if it wanted to help the domestic economy, can't rely on that export growth driver as much as they have in the past. So really what they have is domestic consumption. And the kind of policies we've seen to stimulate domestic consumption so far have been very much of the old playbook and kind of lackluster. You're seeing them cutting interest rates. You're seeing them providing more credit to industrial firms. Mm-hmm. You're seeing them providing some consumption stimulus in the form of vouchers. But really, it hasn't really been sort of anything that's stepped outside the ways they've done before. And if they really are going to stimulate consumption to be the growth driver for China, we really need to do something very, very different on a scale and of a type which they haven't really done before. So maybe we'll see something like that today, or at least an indication of something like that today from the Politburo, but we'll have to wait.
James Mager, Bloomberg senior Chinese economy and government reporter in Beijing. Thank you. President Trump explained what prompted him to change course on tariffs. Take a listen.
Well, I thought that people were jumping a little bit out of line. They were getting yippy, you know. They were getting a little bit yippy, a little bit afraid, unlike these champions, because we have a big job to do. No other president would have done what I did. No other president. I know the presidents. They wouldn't have done it.
Okay, Bloomberg's Valerie Teitel is here. Val, the president talking about some people getting a little bit yippy. Was he talking about the bond markets? You've been leading the focus for us on the route in the bond markets that are led up to this decision. Talk us through how the bond markets react and to what extent the bond markets were the catalyst ultimately for this U-turn.
Tom, it seems like yesterday we realized that the Trump put wasn't in the equity market, it was in the bond market. Him saying that he was watching the bond market turmoil that took place 24 hours ago. And this walk back from these tariffs, Tom, had the market euphoria going insane. The S&P 500 had its fourth biggest swing from high to low in modern history, coming just behind the two best days of the global financial crisis and right behind the snapback day after Black Monday. And this euphoria was followed up by substantial volumes in the equity market. Flip on, I want to show you this chart. It caught me by surprise that the U.S. exchanges set a record yesterday for the volumes behind this move higher in the equity market, coming right behind Monday's move, which had already set a volume record. So two volume records for U.S. exchanges, one on the downside, one on the upside for this crazy week in markets. It was quite a huge move in the front end as well. Those two-year yields at some point yesterday's session crossed 4%, rising 30 basis points on the session. This is as people are slashing their Fed rate cut expectations. We even heard from Goldman shortly after Trump's announcement. They're slashing their baseline call for a U.S. recession. The euphoria also showed up in the corporate bond space. We saw high yield and IG spreads narrow substantially after the last few days of widening out. The IG spreads, Tom, actually had their best performance since 2020 on this announcement yesterday, as we are all of a sudden a bit more rosy on the U.S. economy.
Yeah, at least for now. Bloomberg's Valerie Teitel. Excellent breakdown. Thank you very much indeed. Coming up, the EU approving tariffs on billions of euros of US goods as it retaliates for Trump's metals duties. Those were imposed, of course, last month. And it considers the president's pause on his new levies. We are live in Brussels with the latest. This is Bloomberg. The European Union has approved tariffs to hit around 21 billion euros worth of US goods in retaliation for the 25% duties President Trump imposed last month on the bloc's steel and aluminium exports. For more, let's bring in Bloomberg's Oliver Crook in Brussels. Ollie, as of right now, what tariffs are in place and what are not?
Yeah, Tom, I mean, listen, it's Thursday, so you have a whole new tariff regime than you had on Wednesday, where you had a whole new tariff regime than you had on Tuesday. And so as far as our understanding goes, and again, this is going to be all sort of subject to change over the next couple of hours when we get more and more commentary from the United States and from Europe, is that 20% reciprocal tariff that was due to go in over all exports from the European Union into the United States, that is put on hold. That has been dropped down to a 10% export tariff from Europe into the United States, the so-called minimum rate there. We should say, alongside that, Tom, you still have 25% tariffs on the automotive sector here in Europe. That is one of the major industries here. That is, of course, one of the big issues for the companies, many of the flagship companies here of Europe. You still have 25% tariffs on the aluminum and steel that is being exported from Europe into the United States. And what you had from the Europeans yesterday was retaliation to specifically just those aluminum and steel tariffs. What that is targeting, it is still very modest, Tom. It's about 21 billion euros worth of goods that they're targeting, and you should see on the board there that these tariffs are going to be collected in different tranches in mid-April, mid-May, at the end and the beginning of December, and that was all to give maximum flexibility to the Europeans to negotiate a different outcome with the Trump administration. Now that you've had this partial reprieve from the United States, we heard from Commerce Secretary Howard Lutnick. He says that he expects these tariffs from the Europeans in response to the metal tariffs to be on hold. There is a possibility that will happen. We should also say that going into next week, we were starting to get the conversations about what the architecture would be by the Europeans to respond to the 20% reciprocal tariffs. That potentially is also on ice, but all of this, Tom, very much a moving target as the tariff regime basically has been changing from day to day.
Yeah, we break down the details. The timeline, as you say, is really important as well in terms of how those potential additional tariffs kick in from the EU. Where does this 20% so-called reciprocal tariff, of course, that's been reduced now to 10% on Europe from the Trump administration, where is Europe left right now? It's back down to 10%.
Yeah, Tom, and that's still massive, right? We're still talking about putting a 10% tariff on the biggest trading relationship in the world, $1 trillion trading relationship, 500 billion euros worth of exports going from Europe into the United States. So you had the shock and awe of the 20%. You now have euphoria in the markets. Let's not lose sight of the fact that you still have massive tariff barriers now between the EU and the United States that you just didn't have a week ago. We should also say that for the Europeans, though they could sigh a partial relief in what we've got from the United States, let's also not lose sight of the fact that this is demonstrating to the Europeans, close allies of the United States, what the Trump administration is willing to do and how they're willing to exert pressure. Have they heard the last word on tariffs? Probably not. Have they heard the last word on value-added tax, on tech regulations, all of these sorts of things? Probably not. So while there is short-term relief, there is still going to be a major conversation about what the relationship looks like going forward with the United States.
Bloomberg's Oliver Crook in Brussels. Thank you. Later in the show, we're going to continue our markets coverage, of course, after President Trump announces pause on higher levies for most nations. Goldman Sachs reverses their forecast on recession for the US. That's coming up. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now some of the stories making the news this Thursday. In Germany, Friedrich Merz has sealed a coalition deal with the Social Democrats, paving the way for the Conservative leader to become Chancellor. The 146-page agreement, titled Responsibility for Germany, aims to strengthen the military and domestic security, tackle irregular migration and seek a free trade agreement with the US in the medium term. The deal still has to be approved by the Social Democrats members, meaning Merz isn't likely to succeed Olaf Scholz before early May. And Volkswagen's profit has tumbled in the first quarter. The automaker is grappling with one-off charges and the early effects of US tariffs that are poised to drive up costs for the industry. Operating profit for the period will be about 2.8 billion euros. That's down from 4.6 billion last year. Volkswagen confirmed its full-year guidance, projecting revenue growth of as much as 5% and an operating margin of 5.5% to 6.5%. And Ukraine has requested aid from Washington worth $30 to $50 billion and says it's willing to pay for it. President Volodymyr Zelensky says the nation would pay either directly to the US or as a contribution to the joint mineral deal fund, which is yet to be created. US President Donald Trump is pushing Ukraine for a deal to share future profits from Ukrainian minerals, which he sees as compensation for US assistance since the start of Russia's invasion 3 years ago. Coming up, President Trump pauses higher tariffs on most nations for 90 days. We're going to talk markets with Pooja Kumra, Senior European UK Rate Strategist at TD Bank, how to position in fixed income following this decision. We'll get that analysis and those insights in the next couple of minutes. Stay with us. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom Mackenzie in London. These are the stories that set your agenda. European futures explode higher with stocks set to open up almost 8% after President Trump's tariff pause turbocharges the markets. The S&P 500 closes out its biggest rally since 2008. No relief, though, for China as the US president hikes tariffs to 125%, but says he can't imagine raising them again. Bloomberg understands Beijing's leaders are meeting today to discuss more stimulus measures. Plus, Goldman Sachs drops its forecast of a US recession, but Fed officials say the risk of stagflation remains. Let's check in on these markets then. History made again yesterday. It turns out Trump is for turning, and the bond markets may have been pivotal in that decision. European futures then soaring after dropping around 12% in the last 5 sessions, looking to gain potentially around 8%. FTSE 100 futures pointing higher by more than 400 points, looking to add more than 5%. S&P futures, meanwhile, after rallying around 9.5% by the end of the close yesterday, looking to drop just 0.6%. Nasdaq 100 futures, maybe some profit taking, currently pointing lower by 1% after rallying 12% by the end of the close. Citi, Strategist upgrading their view on US and European equities. Do you lean into this rally or do you take profit? How much volatility is still in the pipeline when it comes to these markets? We're going to look cross-asset, of course, in terms of the moves around the bond markets. You saw that pronounced sell-off, particularly at the long end. At one point, the 30-year saw yields up around 22 basis points. We know that drew the attention of President Trump. The 10-year right now at 4.28, yields are down 5 basis points. Euro-dollar gaining up 0.4%. Brent under pressure down 1.2%. And gold rallying in the session, remaining with that safe haven status, up 1.4% in the yellow metal. So Goldman Sachs reversing their forecast of a US recession, and in quite quick succession as well, after President Trump announced a pause on higher tariffs for most nations. Meanwhile, Fed officials are leaning away from rate cuts that would protect against any tariff-induced slowdown, instead focusing on keeping inflation in check. Bloomberg's Very Titel is here with more. Val, connect the dots for us then.
Maybe the Fed feels vindicated by staying the course with their focus on inflation, and Goldman may be feeling a bit embarrassed by their quick reversal. They called for a baseline U.S. recession about an hour before Trump walked back this 90-day pause on tariffs. And just a few minutes after Trump came out with this pause, they then rescinded their call for a U.S. recession. They still warn that there is a high chance of a U.S. recession, but it's no longer their base case after they said that. And then with the Fed, they perhaps are feeling quite smug, frankly, Tom, that they did not overreact, that they instead, took this wait-and-see approach, really maintained their focus still squarely on inflation instead of excessively warning about a growth hit. And perhaps we see this kind of reversal come more from analysts across the street. Maybe we get some upgrades to GDP forecasts after this walk back on tariffs. But for me, it was the calm in the bond market which did it for me yesterday.
Well, to that point, I mean, you've been leading on this for us from the start of this week, pointing our attention to what's been happening in terms of the bond markets and the dislocations we've been seeing. Is the stability, the relative stability that we're seeing today, is that what is your understanding of to what extent that is sustainable going forward? I
think it's sustainable, Tom, and it's because of the 10-year auction yesterday saw really good demand, and that was before the Trump walk back on tariffs. So already we were on a more solid footing even before this ginormous equity market rally. And to me, that just means that maybe this deleveraging had already made its way through the system, that there was a moment of calm within the Treasury market. Liquidity kind of returned. There wasn't any more gapping around the Treasury auction. We do have another auction today. It's the long end auction. So to me, that is still another catalyst, another risk event. But I expect it to go be taken down well today, given how easily yesterday's auction was taken down by the street.
OK, Valerie Titel, thank you very much indeed. We will watch that 30-year auction as well, as you say, given that the 10-year was well absorbed after a slightly different picture when it comes to the 3-year earlier in the week and the concerns that led to. Now, European investors are poised. Let's stay on the markets with a focus on fixed income, because European investors, of course, poised for quite a morning as markets react to President Trump's pause of most of his so-called reciprocal tariffs. Joining us now is Pooja Kumra, Senior European and UK Rates Strategist at TD Bank. Pooja, good morning. Thank you for joining us. Let's start on the fixed income story then. And if the equity markets of the US are not the guardrails for this president, then arguably the bond markets are, and there was some evidence of that yesterday. Does the 90-day reprieve on these so-called reciprocal tariffs lead to normalization in the US Treasury market?
I think for Temporarily, definitely yes, and that's what markets are pricing. But I think we should not discount the fact that yes, there is a reprieve period, but the effective tariff rate is still above 20% if you look at the China rate and the 10%. So yes, the epicenter of the issue has just been now concentrated to China and not global, but still it is a big knee-jerk reaction to the global trade that we have seen. But definitely, I think when we enter European market, we should see similar reaction that what we saw in US market yesterday, where markets should be less pessimistic about European growth and actually scale down ECB pricing as well.
What do you make from those who say that the events of the last few weeks have fundamentally undercut US Treasuries and their proposition going forward, longer term? Is that a real dynamic we need to factor in now?
I know clearly there was a risk, and especially when we saw the poor 3-year auction, poor foreign participation at the auction did really spook the market, and that's what the price action we saw yesterday. But I think one thing we need to know is USD is still the reserve currency of the world. And you know that Trump is watching the markets very clearly. So when he saw the markets not in the right state, he decided to take back some of the impact. So I do feel, yes, longer term, there is a question, but the question is also what can substitute USD? And so far, we have not found that answer.
Valerie Teitel from our markets team was talking about the fact that the Fed may feel vindicated at this point. They've reiterated that they're prepared to stay and watch this unfold before taking any action. Are the markets getting over their skis in pricing still around 3 cuts this year?
Already seen the slowing soft data, but as we said, that everything is on a hold right now. So ultimately, you're dampening the growth, the momentum in the economy. And US economy is basically driven by consumer. And if the consumer does not spend, that is a big hit to the economy. So we are also always in the camp that the Fed will have to go with consecutive cuts, but we had put all our cuts after June just because that gives Fed more time to absorb the data. Because right now the data is really not reflecting tariffs. Like today we get the CPI, but the CPI will have no impact of the actual tariff. So I think the second half of the year, we could still see a lot of cuts just because there will be, number one, lingering impact of how H1 has been on a roller coaster ride. And no matter what, it is punitive for the consumer in the US.
Talk us through the European bond market reaction then. German bonds, the 10-year, ending the session yesterday just below 2.6. Where do you see the German 10-year by the end of the year? And to what extent do the flows out of US Treasuries into bonds offset any concern about fiscal spend in Germany?
Yeah, so we have, since end of last year, we have actually seen a lot of foreign flows in Europe just because we knew ECB was the only central bank that was cutting. But that entire flow got halted with the entire fiscal that we saw. I think right now, how much flows we see in Europe is, again, a question of how much ECB will be cutting rates. I think the 10% reciprocal scenario definitely actually reduces the pain rate for ECB. And I would say some terminal about 1.75 to 2% seems likely for ECB for us. I think in terms of flows, you will see that EGB spread versus bonds to continue to compress because markets have removed the idea of credit in Europe. So I think the key trade is less about buying bonds, but it will be more about getting that extra pickup via EGBs, SA, covered, senior, going to the corporate side. And I think that's what got spooked in last week's session. If you saw swap spreads, iTraxx index, corporate index, everything did blow out of proportion. So I think that should get some more relief than bonds per se. I think it might be negative for bonds because bonds rallied a lot on a recession-like scenario.
What do you make of the dislocations? Arguably, there were dislocations in the gilt markets yesterday as well, with a really significant sell-off in the 30-year, but money moving into the front year, at least in parts of that session. Does that dynamic continue, Pooja? What are your expectations? Do you want to be leaning into any part of the curve, the front end of the gilt curve?
Yeah, so the gilt market is pretty much has seen some horrendous reactions. So front end, on one side, we are very much anchored with BOE cutting rates and very Fed-driven. But the price action in long end was pretty aggressive. And especially, I think it's more UK market is very vulnerable to global investors and especially US based. So if you have any sell off, you see a lot of liquidation pressure in the UK curve and more so in the long end. And I think yesterday's price action, and we did hear from Billy that they are looking at the bond market as well in their financial comments. I do like holding long 30-year gilts here. I think we have reacted aggressively to this global liquidation, and if we see some kind of better stance in US and a good 30-year auction later today, it should give that ground to long end gilts, which sold off for no fault of them.
OK, interesting call on favouring the 30-year gilt towards the end of that curve, the back end of curve, so the long end of the curve, of course, in the UK. Pooja Kumra, Senior European and UK Rate Strategist at TD Bank on these fixed income markets, of course, on the back of this tariff reversal from President Trump. Pooja, thank you for the time and analysis, of course, as always. President Trump's tariff pause may have sent stocks soaring, continues to do that, of course, in the session today, but significant uncertainty remains for many of the world's largest companies. Charlie Wells is here to talk us through the reality on the factory floor then. Are markets getting ahead of themselves because the uncertainty still is there? There are still 10% tariffs on most nations supplying the US. Talk us through what is happening on the factory floor.
Yeah, Tom, so I think the message from corporate executives and economists is hold your horses here and look at some of these numbers. So Bloomberg Economics put out this really interesting data point, which is that, look, so you've lowered tariffs potentially, but you've raised them on China. That takes that average US tariff rate down, but only down from 27% to 24%, which is still a historic high. You've got other economists talking about how, this is not a situation where anyone can ring the, quote, all clear bell. That was Neil Duda at Renaissance Macro. You've got Michael Ferroli at JP Morgan, their chief U.S. economist, saying we still think a contraction in real activity is more likely than not. That's the economist talking. You're also getting comments from corporate executives. So yesterday, Delta, the American airline, had to pull their forward guidance. Ed Bastian was talking about how it's so difficult to think about the year ahead when trade policy seems to be changing, not from week to week, but from day to day.
What else are you seeing in terms of the business reaction to the tariff uncertainty?
It's significant with businesses that deal a lot with China, right? Because those tariffs are looking like they're going to be incredibly high. And I would say Christmas ornaments tell this story quite well. We're talking about a 90-day pause here. Businesses have to think way beyond 90 days. Walmart uses a factory in China that makes Christmas ornaments, and the factory has told Bloomberg that they've been asked not to put sticker prices on those products because there is so much uncertainty about how much things might cost. Bloomberg has also learned that Amazon has canceled a number of orders abruptly from factories in China, and then Kohl's as well, the retailer in the United States, put in orders very recently. Some of the raw materials executives told Bloomberg were ordered, and then Kohl's retracted and said to stop production. So this is causing a lot of chaos and uncertainty because of this kind of stop-start element here.
Charlie Wells, thank you very much indeed. Breaking down the corporate reaction to the continued tariff uncertainty, even as there is something of a reprieve, at least over the next 90 days. Now, some other stories making the news this Thursday. Prada shares are higher in Hong Kong after sources tell us the Italian fashion giant is nearing final approval to buy struggling rival Versace. We're told Prada and Versace's owner, Capri, are discussing a lower price of €1.25 billion due to tariffs and turnaround needs. The sale would return Versace to Italian ownership. And estate agents are warning the UK housing market is in danger of being blown off course by President Trump's trade war. The Royal Institution of Chartered Surveyors, RICS, says its gauge of buyer demand plunged deeper into negative territory in March to its lowest since September of 2023. The institution's price index, meanwhile, dropped 9 percentage points to its lowest since last August. The world's richest people added $304 billion to their combined net worth as stock markets soared after President Trump pledged to pause tariffs on some trading partners. The move boosting the world's 500 richest people's wealth by an average of 3.5%. It's the largest one-day gain in the history of the Bloomberg Billionaires Index. The largest individual gainer was Tesla CEO Elon Musk, who added a cool $36 billion to his fortune. Coming up Pharma stocks under pressure after President Trump says tariffs on the sector are coming soon. We discuss what is at stake for the industry. That is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. President Trump is doubling down on his tariff plans, at least for the pharmaceutical industry. That's despite, of course, announcing a pause on wider tariffs for most nations. I'm joined now by Sam Fazeli, Director of Research for Global Industries and Senior Pharmaceuticals Analyst for Bloomberg Intelligence. Sam, thank you for joining us bright and early this morning. Let's talk about the here and now and the fact that a number of the stocks listed in the US, drug makers, barely moved yesterday. Everything else was soaring. You have companies like AbbVie, was up just 0.1%. Let's start with that immediate reaction and we can push forward.
Yeah, we felt really left behind for the pharmaceutical stocks. I was watching, NASDAQ ended up, 11% or whatever, up at the end of the day. Apple, everybody was jubilant, except for pharma industry, because they haven't had their moment yet in terms of what tariffs they're going to get. The president had said, either earlier in the day or the day before yesterday, that he will be bringing tariffs. We will be tariffing our pharmaceuticals. So that's still, that particular dagger still hangs over their heads.
What would 25%, if we take the auto sector as a case study, what would 25% on the pharmaceutical industry mean in terms of levies? Where would the pain be felt?
I wish I could tell you. The problem, Tom, is that the pharma industry is very opaque in terms of where products are made, how they're transferred, and one product isn't just a product. Take cars, for instance, the bits that go back and forth across the borders, etc. But at least the auto industry tells us a little bit more. Here, we don't know much. What we do know is the percentage of the value of drugs and the volume of drugs that are imported into the U.S. from different countries. Mexico, from what I recall, about 33% by volume, 1% by value, which tells you what types of products are being imported.
Interesting.
Ireland, 24% by value. A lot of pharma companies have moved their intellectual property hub to Ireland for an obvious reason. Corporate tax levels are lower there.
OK, so Ireland, to some extent, is in the eye of the storm because you have that value, if not the same volumes as countries like Mexico. When we think of drug makers, there's a number of big names. Of course, Europe plays a central role in this. But Novo Nordisk, given the role of Ozempic, to what extent is Novo vulnerable to this? There's still massive demand for Ozempic and Wegovy in the US market.
But both Novo and Lilly have committed to new manufacturing efforts in the US. Big money, right? Much like Apple had, the $500 billion that they did. So the fact is, however, that you can't just turn them on. It just doesn't work like that. Yeah, you don't want to, because these are products that need to be safe and effective every time that so the patients get the same drug every time. What's happening with the Novo Nordisk is a double whammy. Not only is a pharmaceutical company that's importing products into the US, you also have the HHS head not particularly in favor of obesity drugs, although they're much more than that. You also have the fact that it's a Danish company. Remember that Greenland conversation that's been going on? So you've got too many pressures here and too many unknowns. We don't know where it's going to go. What's going to be the tariffs on these things? Number one. What's going to be the relationship with Denmark? Don't know.
What is the ability for these companies, and thinking of Novo and others, to absorb some of the cost, given some of these companies have pretty healthy margins?
They do, but those margins will get squeezed. But what percentage is very tough to tell. Two areas to look at. One is the cost of goods line, the gross margin, which is if your imported cost of material is going up, your cost of goods will go up. If there's tariffs on China for very early raw ingredients, etc. The other one is if your ability to manufacture in low tax areas and pay the tax there and then do a transfer pricing to your US subsidiary at much higher price, that would then also impact the EPS, but lower down in the profit and loss account.
You touched on the changes that we've seen at the head of some of these regulators, drug regulators and healthcare regulators in the US, HSS, the FDA as well. How significant is that for the pharma industry? Can they look through some of those changes? There will be normalcy, new people will be hired, new people will be put in place, or how substantial and significant is this?
There will be normalcy. That's an interesting comment. Who knows? The reality is that we're dealing with a new administration with a new playbook. They have different interests in what they want to achieve for the United States, and some of those don't align with what was the interests prior. So the fact that we're seeing upheaval at the FDA is not going to help any of the companies in terms of at least planning for the timing of approval of drugs, the attitude to the approval of drugs. One of the persons who left, Peter Marks, was very open to these rare disease drugs and having a relatively low bar for bringing drugs to market where there is no drug. So they were a bit more lenient, sometimes too lenient, for some of these products. What's the attitude going to be going forward? That we have to wait and see. So there's uncertainty, which of course is not good for stocks.
Well, uncertainty layered on top of uncertainty.
On top of uncertainty.
Thank you very much indeed. Always excellent, of course, breaking down the impacts across the pharma industry on these potential tariffs and, of course, changes when it comes to the regulators in the US. Sam Fazeli, Director of Research for Global Industries and Senior Pharmaceuticals Analyst for Bloomberg Intelligence. There's lots more coming up. Stay with us. This is Bloomberg. So President Trump is for turning. Another one for the history books then. The swings from highs to lows across the S&P yesterday, close to 11%. That is one to notch in the diaries then. In terms of the historical president, the S&P, of course, ended up 9.5%, the biggest gains we've seen since the great financial crisis. Let's briefly check in on the futures and European futures firmly on the front foot. Again, more historical comparisons here. If the future story plays out as it is currently looking at, up 8%, close to 8% in terms of the push through coming through from the US, from Asia, of course. FTSE 100 futures looking to add 5%. Bit of profit taking maybe for the S&P, Nasdaq 100. To what extent do you want to lead in to the gains? Commodities as well. After pressure on the metal space, you're seeing a rebound for copper, you're seeing a rebound for iron ore, and you're seeing gains once again for the yellow metal, proving that safe haven status remains above 3,100 right now per troy ounce. A gain of 1%. Copper firmly in focus, up almost 5% in the session. So watch the miners at the open, 8 a.m. UK time, across the sectors, actually. The gains are going to be pronounced. Stay with us. The opening trades is up next. This is Bloomberg.